and getting my exercise and coming down to the audience and coming back up here. So I'm going to give you guys the opportunity, since I just presented a little bit ago, I'm going to give you guys the opportunity to talk about any stocks or companies or questions that you have about the financial markets. And I'm going to have it come down. You guys are going to speak into the microphone with a question. I'm going to come back up here and maybe display it on the charts so that we can look at it. So I'm just launching some applications very quickly here. And hopefully we'll have some questions about the financial markets as I gather in a little audience here. Huh? I scared them. I'm not scary. So, again, as I mentioned, if you have any questions on the financial markets, we're going to go ahead and answer them the best I can. And we're actually going to look at real examples. So we're going to compare it to live in the market examples right now. All right, one more application to open up. So before I come down and see if I can get any guinea pigs, I'm going to show you guys a chart of the stock market and what's been going on over the past 12 months, basically. So, for all of you in the audience, the stock market, let's start here in January. Let me click down here on my cursor. So this is where we were in about January 1st. I'll bring up the actual stock market, real example. So, January 1st, we were about 10,000, let's just round it to 10,600. Right now, we are at 11,400 roughly. So in this year, we've done $800 on our $10,500 index, basically. So just under 10%. And as I mentioned in the last presentation, who knows the average over the past 30 years of stock market returns? Per year, 10%. So 8% so far this year. We've got about 8 weeks left, 7 or 8 weeks left. Maybe we'll get that again. Obviously, on top of 2009. I'll go back a little bit further in time. So here we are. The bottom of 2009 was March at around 6,700. And here we are at 11,400 today. We've more than doubled, well, almost doubled in value, basically. Not a bad 2 years. If you go further back in time, we'll go back pre-crash. Here we were pre-crash in 2007, and then the crash of 08. So as you can see here, roughly 14,000 down to about 7,000 and back up to 11,000. Well, we're basically right in the middle or just above the middle. So one of the technical analysis tools that I mentioned in the last presentation that I love is called a Fibonacci retracement. If you've ever seen the movie The Da Vinci Code, Fibonacci retracements show up in the Da Vinci Code and in Leonardo da Vinci's paintings. So this actually does those retracements for us. We have retraced about 61% of this down move. So we've gotten back 61% of those gains that we lost in that 2-year fall here. So now the question you have to ask yourself, is this a good place to trade? Is this a good place to invest? The stock market's been roaring for the past couple years. The stock market's been roaring for the past couple of months. Now we have to decide risk-reward. Is it a good time to invest our money in the stock market, in individual stocks, in commodities like gold? We have a vendor here, right here in row 300 that does coins, so obviously gold and silver, that you can talk to them about prices. They have a good handle of it, and I can actually show you some gold prices and things like that on the charts. So that's what we do as technical analysts, is we look at charts, we looked at factual-based data and say, is this a good risk-reward opportunity? So I'm going to pick Ron as my first guinea pig. Ron, you want to take a look at a stock?
Sure. Yeah, Ford.
Everybody hear of Ford out there? Ford? Good common stock, right? I think we know about them. All right. We're going to bring this down to a little smaller time frame. Here is Ford over the past year. Let's talk percentages, because that's what traders like to focus on. A year ago, it was at about $8. Today, $16. What's that return in 1 year? 100%. Not a bad year. Stock market averages 10%. Ford, has done over 100%. So a very, very good year in Ford, and it's probably done a little bit better than that if we look at a longer time frame. So again, the question is, with this return, maybe Ron owns Ford. As I talked about before with options, he might be nervous and saying, holy cow, Ford went from bankruptcy almost, or about a couple bucks, all the way up to about $16 in the past year and a half. I might want to book some of my gains. Maybe I could take some of my stocks off the table and sell some of my stock ownership. Maybe I could use the strategy that I talked about just about an hour ago, covered calls, and I can sell some covered calls against it and generate income, the number one way to generate income on my portfolio. Maybe I'm nervous and I can buy puts, protective puts, or what we call married puts, and say, I'm nervous if the stock goes down, I'm going to lose some of my portfolio that Ford is holding, and I can buffer that by making some money to the downside. So options, as I mentioned, give you lots and lots of different strategies how to defend, in Ron's case, how to defend his stock ownership in Ford. Anybody else would like me to take a look at a stock? Anyone in the crowd? Crocs. All right. So they're on our feet, right? Crocs. Let's look at the long-term chart of Crocs. All right. Anybody hear of a bubble before? All right. Crocs were a bubble. They were at $70 a share, making rubber shoes and boots and things like that. And when the markets fell, a lot of stocks fell, a lot of sectors fell. Well, Crocs fell very hard. They went basically towards bankruptcy. So obviously they took a hard fall, whether there were fundamentals and other factors in there. They've recovered a little bit, but as you can see percentage-wise, they haven't recovered nearly as much as the overall stock market and a stock like Ford. So you could say that we use leaders and laggers and words like that. Well, Crocs is a laggard. It's not making up the performance that you would think with the stock market doing very well. It's doing okay, but it's not made back nearly the percent that we've seen in other stocks. So that's a fun one to look at. That actually reminds me of the NASDAQ. If you remember back in 99 and 2000 when the NASDAQ was crashing, this is what the NASDAQ looked like. All these companies, buy, tech. And then all of a sudden, they all lost their value, and some of them, as we know, aren't around anymore. So again, that's why the charts help us to say, do I want to be a buyer? Do I want to be a seller? Where are other people buying? Well, the chart tells me where other buyers are accumulating and where interest is in this stock or this sector or this commodity. The charts tell me where there's resistance, where there's sellers coming into this stock or this chart of any company out there or a commodity. So I'll run around here real quick. Anyone else have a stock that they want me to look at?
ESPH.
All right. We're going to look at ESPH. So this is a technology company. All right. Let's bring it down here. Okay. This is what is known as a penny stock. Stocks below $5 basically are penny stocks. They're very hard to read. For what I do, what I use is called technical analysis. I like to read the flows of a stock chart. Penny stocks get harder to read because they're a penny stock. They could go out of business tomorrow, or they could be worth $100 for their stock tomorrow. We don't know. So there's a lot more going on to this company. And percentage-wise, the moves are very, very great. So it's very volatile. Because you can see, if it moves 25 cents of a 75 cent stock, that obviously is a huge, huge, huge percent. So it's a very hard one to trade. The other thing you want to look at is volume. Volume is down here at the very bottom. It's basically non-existent. So what that means for you, if you buy this stock, are you going to be able to get out of it tomorrow, or if you need that cash? So liquidity is something you want to think about. So what I like to do is tell my clients, I say, pick household names, Home Depots, stuff that's going to be around every day. Let's start talking about the intermarket relationships that I mentioned before. If the housing market is booming because the economy is booming, what's going to happen to Home Depot's stock? Which way is it going to go? It's going to go up. That's an easy relationship. Ecosphere Technologies. If they say we're closing the books tomorrow, you're done. You don't have a shot at getting your money back, basically. And with a penny stock with very low valuation, yeah, that could happen. So I tell people to grab household names that everybody else is trading out there. This one is a little bit more difficult. It has a higher, basically, beta. It has more volatility compared to the overall markets. All right. Got another one? Anybody out there have another one? Another company? Any company they can think of? I'll bring one up. Anyone else? Let's do, what about a clothing company? What about, or actually something in the retail sector like JCPenney? Right? We all know JCPenney. So here's JCPenney's stock. And remember, I use those words support and resistance. So this stock obviously does not like being above $34. How do I know that? Because there's factual data. Right here, in the middle of October, it hit $34 and bounced off and went down. Previously, back in April, it hit $34 and went down. Does it take a surgeon to understand that $34 is the roof or the ceiling or resistance for this stock? Probably not. I can figure that out as a ski bum. You guys can figure that out. What about the opposite side, support? As I told you, support is accumulation. It puts a bottom in the markets. Well, obviously, around $20, this stock could not go any lower. Enough people bought it, investors, people like you and me, bought JCPenney's stock, and it turned it around and went up, and it's done phenomenally well. Maybe this area of September, October, back to school, maybe it had a good earnings report, things like that. But percentage-wise, $20 to $33. $13 on a $20 stock, let me do the math, that's more than 50% in 2 months. And on top of that, it hits its previous resistance level and says, you know what, I'm tired. I can't go any higher. Well, some people are booking profits, like we were talking about Ron. Hey, Ford's gone up a lot. I don't know how greedy I want to be. Greedy is a big word in emotion and discipline. Well, if I don't want to be greedy, maybe I'm going to take some money off the table. Maybe I'll do some defensive strategies, things like that. Think about the word hedge, hedge funds. We hear them all the time. Hedge funds buy something and they sell something. They buy something very strong and they sell something up here that they think is overvalued or weak, and one hopefully goes down and the other one goes up, and that's how they get better returns than the average investor can, and they get better returns than the S&P or the Dow Jones or just the average markets, because they have traders that are very good at reading this. You, as an individual, can become very good at reading this because, as I said, how hard is it to see resistance or a ceiling at 33? How hard is it to see support at $20? It's factual data. We can use past performance to indicate, hopefully, future performance. And the bottom line is, if we have a loser and a trading plan and all that kind of stuff, great. Losing is a part of the game. I'm okay with that. But I'm around to play in the markets tomorrow, next week, next month, next year, because I had money management. So because we have the gold guys over here, we're going to look at gold one more time. Okay? So this is the ETF, which is basically a index that represents gold prices. So it's 10% of the price of gold. An ounce of gold right now is $13.90, $13.94. So this is an ETF that is basically makes it more affordable. $1,394 might be a little bit expensive. So we can buy an ETF that represents gold at 1/10 of the percent. So 1/10 of the value of gold at $13.94 would be right around here, roughly 136, somewhere around there. So it makes it a little bit cheaper for me to go invest in gold. Look at that trend in gold. Look at that trend over the past year. Gold has gone crazy. A lot of this is attributed to our monetary policy, mainly Ben Bernanke and our Federal Reserve saying, we're going to do anything we can to buy and support our economy, and what they're doing is devaluing the U.S. dollar. Your dollar is worth less overseas. All right? So basically, that's our monetary policy. That all comes into your business decisions. Maybe you have a business that's overseas. Maybe you deal with currency rates. Well, you can make money and hedge yourself by using gold prices and understanding the dollar and all of these intermarket relationships. Think about Walmart. They pay labor all around the world. They have to transport and use energy to get things over to America as we consume them. Well, they're using energy prices. Energy prices are priced in dollars. The more energy they use, the more they want to hedge themselves from spikes in energy. Southwest Airlines did it the best. Out of United and all of these different airlines out there, Southwest made the most money by hedging their fuel costs. When fuel went up due to Katrina and that disaster basically about 5 or 6 years ago, we know that energy prices spiked. Well, they had a bunch of traders buying energy, buying oil futures. And when they went down the other way, they had people trading it the other way. So not only did they make money selling a ticket to you, but they made added income because they made money in oil when it went up, and they made oil when it went down, made money down because they're allowed to short it. So these are things that the average person can grasp, is these kinds of relationships. So again, if you have questions about the markets, about stocks, about these relationships, how to protect your portfolio, how to add income to your portfolio, my name's Brian. I will be over here at the NSRO desk, and I'll be talking about self-directed investing. Thank you very much.